Is the US stock market about to crash, or is this just another buying opportunity? Right now, investors around the world are asking the same question. After years of strong growth, rising interest rates, and increasing global uncertainty, the direction of the US stock market has become more unclear than ever. So what's really going on? And more importantly, what should investors do next? To understand where the market is going, we need to look at three key factors: the Federal Reserve inflation and corporate earnings. Let's start with the Federal Reserve. The Fed has one main job: controlling inflation, and the main tool it uses is interest rates. When interest rates are high, borrowing becomes more expensive. This slows down the economy, but it also puts pressure on stock prices, especially growth stocks. Why? Because when interest rates are high, investors can earn returns from safer assets like bonds, so they don't need to take as much risk in the stock market. This is one of the main reasons why markets become more volatile during high interest rate periods. Now let's talk about inflation. Inflation is the silent force behind almost every market move. When inflation is rising, the Fed keeps interest rates high. But when inflation starts to fall, the Fed can begin to lower rates. And this is where things get interesting, because markets don't wait. They move based on expectations. If investors believe that rate cuts are coming, markets can rally even before anything actually happens. This is why you sometimes see stocks rising even when the economic data looks weak. Now let's move to the third factor: corporate earnings. At the end of the day, stock prices follow profits. If companies continue to grow and generate strong earnings, the market can stay strong. But if earnings start to decline, the market will eventually follow. This is especially important for large companies like Apple, Microsoft, and Nvidia, because they have a huge impact on the overall market. Now let's put all of this together. What are the possible scenarios? The first scenario is a soft landing. This means inflation slowly decreases, the Fed keeps rates stable, and the economy avoids a recession. In this case, markets can continue to move higher, but in a more gradual and controlled way. The second scenario is a bullish breakout. If inflation drops faster than expected and the Fed starts cutting rates, we could see a strong rally, especially in technology and growth stocks. The third scenario is a downside correction. If inflation rises again or the Fed remains aggressive for longer, markets could face a significant pullback, possibly 10 to 20%. So what should investors do? The biggest mistake investors make is trying to time the market perfectly. Instead, many experienced investors follow a different strategy. They invest gradually, they diversify, and they focus on the long term. Because in the long run, markets tend to go up, but the journey is never smooth. There will always be volatility. There will always be uncertainty. And that's exactly what creates opportunity. If you are a long-term investor, periods of uncertainty can actually be the best time to invest, because prices are often lower, and fear creates discounts. But if you are investing for the short term, things become much more unpredictable. Markets can react quickly to news, to Fed decisions, to geopolitical events, and to unexpected economic data. This is why having a clear strategy is so important. You need to know your time horizon, your risk tolerance, and your goals. Because without a plan, it's easy to make emotional decisions, and emotional decisions often lead to losses. So where are we right now? We are in a market that is not extremely cheap, but also not extremely expensive. We are in a transition phase. A phase where the market is trying to figure out what comes next. And in this kind of environment, patience becomes one of the most valuable strategies. In summary, the future of the US stock market depends on three key factors: the Federal Reserve inflation and corporate earnings. If inflation continues to fall and the Fed signals rate cuts, markets could move higher. But if inflation remains sticky and rates stay high, volatility will likely continue. The key is not to predict perfectly. The key is to be prepared. If you want to understand markets better and learn how to build long-term wealth, make sure to subscribe for more simple and clear investing insights.